Have you ever thought that why some people can secure larger loans for their dream homes and investment properties while others struggle to get even a fraction of that? What if I told you that it's not about your income only, it's about knowing the right strategies which you can reuse at the right time so that banks practically line up to give you more loan to secure more assets. Hi guys, this is John Sachdev from Admire Property Group, and today I'm going to discuss some of the strategies which we can use to increase our borrowing power, especially in the times of higher interest rate where it's becoming difficult for everyone to get increased borrowing power. So if you're interested in knowing that, keep watching. The basic formula which all the banks use to calculate your borrowing power is income minus expenses. So higher the income or lesser the expenses, the more the borrowing power you will get. So in this video, we will not discuss about increasing the income, but we will discuss different strategies where we can reduce our expenses. So it will give better figure to the bank and bank can give us more borrowing power. So the first point is extending your loan terms to reduce your monthly repayments. So most of the loans which we get are spread over 30 years where you pay the principal amount plus interest towards the loan every month. But if you have been paying for your loan for the last 4 years or 5 years, what you can reconsider is extending your loan terms back to 30 years. Extending your loan over 30 years again will reduce your monthly premium, resulting in reduction in your monthly expenses by spreading your debt over another 30 years. So this is a very useful approach for increasing your borrowing power. So I will take you onto my screen to give clarification of these scenarios. Consider the scenario one where you have got a loan of $400,000 and loan term is 20 years and interest rate is 6%. If you see your monthly payments are coming out to be $2,865. The figures which I have used, I have taken just an online calculator to calculate all these figures. So this monthly payment of $2,865 roughly. And in this span of 20 years for this loan, you will be paying an interest of $287,000 roughly. But if you extend the loan terms to 30 years, in scenario two, where the loan amount is same as $400,000 and loan terms is 30 years and interest rate is 6%. The monthly payment comes out to be $2,398. So there is a difference of roughly $500 on monthly expenses. So this means you are reducing your monthly expenses by $500. So it will give you a chance to increase your borrowing power. But the downside of the option two is you will be paying a lot more in the interest expenses. But if you consider you are investing into an asset which is giving you a better growth as compared to the interest payments you are paying over the span of 30 years, it is a better outcome actually. But to cover up that as well, what you can do is once you are done with your borrowing power and once you have taken another loan and have invested in the asset, you can start making some extra payments of closer to the difference, like $500 on monthly basis. So in that scenario, the loan term will be 30 years, but because you are making the extra payments on monthly basis, the interest will be the same as it was in this scenario of the 20 years. You will be paying almost the same interest expenses, like $287,000 over the span of 30 years, but you will be making extra payments to keep your interest expenses lower. So the main benefit in this approach is these extra repayments which you are making to reduce your interest expenses. You can switch them on or switch them off whenever you want. If you want to go for borrowing another loan for down the track in 1 year or 2 years time, you can switch off these extra repayments so that your expenses are lower and you can borrow the money again to invest in the asset. But the caveat to this approach is you need to check with your bank or your lender to make sure you are switching off these extra repayments on the proper time so that they can consider your expenses as lower expenses and give you the borrowing power. You can see that extending the loan term is giving you a chance to reduce your monthly repayments and reducing your monthly expenses, which will give you a chance to increase your borrowing power so that you can use that borrowing power in buying a good asset in good location where growth is higher as compared to the interest charges you are paying. So this is the strategy which most of the investors are using by taking calculated risks to increase their wealth over a long term. The next strategy which you can use for getting a better borrowing power is take the leverage of the power of a professional, like a mortgage broker. A mortgage broker has good access to 30 or 40 different lenders, and all these lenders have got different policies and different regulations to give you the borrowing power. I know there's a lot of information available on internet, and most of the people try to get their borrowing power by themselves. So they can go up to one bank, two banks, or three banks only. But a mortgage broker will have access to 30 different lenders, and he can navigate through the policies of these lenders and can give you a better product, which will give you an increased borrowing power as compared to you going to two or three options only. Outsourcing the task to a professional gives you a chance to be familiar with all these changes happening in the market and gives you a chance to increase your borrowing power. It is very critical to have a good mortgage broker in your team. Outsourcing this task to a mortgage broker will give you a chance to get familiar with all the policies and changing interest rates. I will give you an example. One of my clients got access to additional $150,000 of borrowing power by just changing the bank. Bank policies change very frequently. So depending upon the economic scenario going on, sometimes they relax their policies and sometimes they stick to their policies. So a good mortgage broker in your team can navigate through these options and can come up with a better solution for you, which will give a better borrowing power to you. Navigating all these options by yourself will limit your options. So make sure you have got a good mortgage broker in your team to have access to better borrowing power. The next strategy which you should use to eliminate or reduce your bad debt. You should know the difference between a good debt and a bad debt. An example of a good debt is if you have got loan over a rental property which is giving you an income and which is increasing in capital value every year. So you are getting a double benefit. So it is a beneficial. And example of bad debt is if you have got loan for a car which is losing value every year, or you have use a credit card to buy a luxury item which you will be using once or twice in a year. So these are the examples of the bad debt. I would ask you a simple question. Would you rather pay 20 to 21% interest on a credit card which you're using to buy an item which you're using once or twice in a year, or would you rather pay 4 to 6% interest on a loan for a rental property which is giving you an income and giving you a capital growth as well? Make sure to give me an answer for this question in the comments below. For example, if you have got a credit card of worth $10,000 limit and you want to go to check your borrowing power, the bank manager will consider this $10,000 as a potential debt, and he will take these as expenses in his calculations and will give you the borrowing power after that. So $1,000 worth of credit card can reduce your borrowing power by 5 times or 6 times $1,000. So if you got the credit card of limit $10,000, so it will reduce your borrowing power by $50,000 to $60,000. Reducing your credit card limit or getting rid of your credit cards can increase your credit score, and eventually it will increase your borrowing power. So make sure to get rid of all your credit cards if you're not using them. And if you are using them, try to reduce your spending so that you can get rid of those credit cards. I hope you're enjoying the video, guys, and all these strategies. The best 2 strategies I'll give you in the last of the video. So make sure you stay up to the last of the video. The next strategy is refinancing your existing debt. For example, if you have got a car loan where you are paying 10%, 11%, or 12% interest rate, you can reconsider refinancing this and try to consolidate this loan with another investment loan where you are paying lesser interest rate. So this way you will reduce the interest rate and eventually will reduce the expenses, will give you a better option for the extra borrowing power. The point is, most of the times I've seen that people stay with the same bank for a longer time and they don't pay any attention to the interest rates they are paying to the bank. And most of times these banks penalize their existing customer database and they come up with new reduced rates for the new customers only because they want to increase their loan books by writing new loans. So it is your responsibility to keep a check on all these interest rates, or you can get some good professional like mortgage broker to keep checking all these things for you on 6 monthly basis, and he can come up with better options with changes in the policies of the lenders. So these brokers can navigate the complex lending market and can come up with better solutions. For example, if you got a loan of $1 million and with a reduction of 1% in the interest rate will save you $10,000 on annual basis, which basically mean will increase your borrowing power by up to 5 times or 6 times, like $50,000 or $60,000. Understanding the potential saving by reducing or refinancing your loan is a crucial step. So make sure you check your rates today and make sure you're not paying extra in interest expenses. And guys, the next two strategies which I'm going to discuss now are the best strategies which most of us don't know about it. The first one is the shading of the income. So what happens in shading of the income? Like, for example, if you have got an investment property and you are getting a rental income, and you are going to a bank to get your borrowing power calculated, what they will do is they'll shade away some of the portion of the rental income. For example, if you got an income of $30,000 coming from a rental property, some banks will shade away 30% of that income, and some banks will shade away 20% of that income, and other lenders can shade away only 10% of that income. So if you're getting $30,000 income from a rental property, if the bank shades away 30%, they will consider $21,000 as your income. On the other side, if the bank is shading only 10%, they will consider $27,000 as your income. So there is a difference of $6,000 with the shading percentage of different lenders. So a difference of $6,000 can increase your borrowing power by another 30-40 grands. For example, if you want to buy a property or your dream home and you are getting short in borrowing power by 30-40 grands, so this little trick can help you in increasing your borrowing power and can help you in getting that asset. So you should talk to your mortgage broker who can go through different products in the market and can give you a better option. But you will have to be careful. Sometimes bank shade away less percentage, but they charge more interest. And sometimes they shade away less percentage and give you the same interest rate. So you should be very careful about choosing your product. And last, not the least, is like splitting your borrowing power. For example, you go to the bank and bank says that your borrowing power is $800,000. So rather than spending the whole borrowing power to buy one asset, you should consider buying only one asset of worth $450,000. And in 3 months or 6 months time, when asset grows in the value or it gives you rental income as well, you can consider the next asset. So in this way, the bank can maximize your borrowing power up to $900,000, like $450 for your first asset. And in 3 months time, with the increasing in rental income and increasing growth, another $450,000 for your next asset. Banks are happier to give you smaller loans, which you can spread out in different locations. That reduces their risk rather than giving you a bigger loan restricted to one investment only, and that increases their risk as well. And moreover, this strategy gives you a better chance to diversify your portfolio in different markets and taking the benefit and leverage of different markets in your portfolio growth, resulting in a win situation for both of you and bank as well. I hope you enjoyed the video, guys, and it has added some value in your knowledge. And I'm sure there should be at least one strategy which you didn't know about before. And if you can, let me know like what was that strategy and put the comments below. That would be really appreciated. It will help us in spreading this valuable information to the other people as well. If you know any other strategy which you would like to share, make sure you put it in the comments below so that I can go through it and I can increase my knowledge as well. So bye for now and see you in my next video. Thank you.